If you're a freelancer thinking about retiring early, maybe at 50 or 55, you've probably run into the early withdrawal penalty. The IRS hits you with a 10% penalty if you withdraw from your retirement accounts before age 59 and a half. But there are legitimate exceptions that let you access your money earlier without that penalty. I'm going to show you every exception to the 10% early withdrawal penalty, which ones apply to freelancers, and how to withdraw before age 59 and a half without extra taxes. First, the basic rule. If you withdraw money from a traditional IRA, Roth IRA, 401k, or solo 401k before you turn 59 and a half, the IRS charges you a 10% penalty on top of ordinary income tax. Example, you're 50 and withdraw $50,000 from your solo 401k. You'll pay 24% income tax, that's $12,000, plus a 10% penalty of $5,000. Total tax hit, $17,000. But if you qualify for an exception, you skip the $5,000 penalty. Exception 1, the rule of 55. If you have a 401k and you separate from service in the year you turn 55 or later, you can withdraw from that 401k penalty-free. For freelancers, this works if you have a solo 401k and shut down your business at age 55. If you roll your 401k into an IRA, the rule of 55 no longer applies. Exception 2, the rule of 50 for public safety workers. Police officers, firefighters, EMTs, or air traffic controllers can access their 401k penalty-free starting at age 50. Exception 3, 72T CPP. This is the most flexible exception for early retirees. It lets you take penalty-free withdrawals from your IRA or 401k at any age, even in your 40s, as long as you follow specific rules. You calculate a payment based on life expectancy, then take that same amount every year for at least 5 years or until 59 and a half, whichever is longer. The payment is locked in. If you break the rules, the IRS retroactively applies the 10% penalty to every withdrawal plus interest. Exception 4, disability. If you become totally and permanently disabled, you can withdraw penalty-free at any age. The IRS definition is strict. You must be unable to engage in substantial gainful activity, certified by a physician. Exception 5, terminal illness. New for 2026. If a physician certifies you have a terminal illness expected to result in death within 84 months, you can make penalty-free withdrawals. Exception 6, long-term care insurance. New for 2026. You can withdraw up to $2,600 penalty-free to buy LTC insurance for yourself or your spouse. Exception 7, medical expenses. If you have unreimbursed medical expenses exceeding 7.5% of your AGI, you can withdraw the excess penalty-free. Example, AGI is $60,000. 7.5% is $4,500. If you have $10,000 in medical expenses, you can withdraw $5,500 penalty-free. Exception 8, health insurance premiums if unemployed. If you've been unemployed for 12 consecutive weeks and you're paying for health insurance, you can withdraw from your IRA penalty-free to pay those premiums. Exception 9, first-time homebuyer. You can withdraw up to $10,000 penalty-free from an IRA to buy your first home. This only applies to IRAs, not 401ks. Exception 10, IRS levy. If the IRS seizes your retirement account to pay back taxes, the withdrawal is penalty-free. Exception 11, QDRO. If you're divorcing and the court orders part of your retirement account goes to your ex-spouse, that withdrawal is penalty-free. Exception 12, Roth IRA contributions. This is a big one. If you have a Roth IRA, you can always withdraw your contributions penalty-free and tax-free at any age. The 10% penalty only applies to earnings, not contributions. Example, you're 50. You've contributed $100,000 and it's grown to $150,000. You can withdraw the $100,000 in contributions penalty-free and tax-free. Now let's talk strategy. Strategy 1. Use the 72T SEPP rule. Set up a payment plan based on life expectancy and take the same amount every year until 59 and a half. Strategy 2. Live off Roth IRA contributions. Withdraw those contributions anytime, penalty-free and tax-free. Strategy 3. Build a taxable brokerage account. No age restrictions or penalties. Access money anytime. Strategy 4. Use the rule of 55 with a solo 401k if you shut down your business at 55 or later. Strategy 5. Plan for exceptions like medical expenses or disability. Here's what most people get wrong. They think exceptions mean unlimited withdrawals. That's not true. The 72T rule locks you into a specific amount. The medical expense exception only covers the amount above 7.5% of AGI. The homebuyer exception caps at $10,000. Another mistake. Thinking the penalty waiver means no taxes. The exceptions waive the penalty, but you still pay ordinary income tax on traditional IRA and 401k withdrawals. Here's what you need to do. First, figure out which exception applies to you. The 72T rule is the most flexible but requires careful planning. Second, consult a CPA or financial planner who specializes in early retirement. The 72T rule has strict requirements. Third, build multiple income streams. Roth IRA contributions, taxable brokerage accounts, rental income. The 10% penalty is avoidable if you know the rules. You can access your money before 59 and a half without getting hit with extra taxes. If this helped, subscribe for more early retirement strategies. Drop a comment if you're planning to retire early. See you in the next one.